In this week's video, we'll review the latest charts to help us answer the question, will the new year bring a painful correction in stocks? We'll get back to our regularly scheduled programming next week. This week's video will take a quick look at the market's risk-reward profile. It's very easy to forget just how concerned market participants were prior to the U.S. election. This is the title slide here from the October 30th video, where we basically asked, are we set up for an epic crash or a monster rally? If you go back and watch that video, the charts that we covered turned out to be incredibly helpful. Thus, it might be helpful to revisit some of those exact same charts as we head into the new year. A slide from the October 30th video, Triple Q's Nasdaq 100 relative to TLT. And as we head into Q1 of 2021, these topics are still relevant. During risk-on periods, stocks obviously tend to significantly outperform bonds, and during risk-off periods, bonds tend to significantly outperform stocks. Clients and regular viewers may remember from that October 30th video, he basically said October 30th looked better than this period here and this period here. We had a breakout, and we had held that breakout for 11 weeks as of October 29th, in this case, a slide that was covered on October 30th. This looked quite a bit different from this sharp rejection here in Q4 of 2018, and this looks quite a bit different than this sharp rejection in Q1 of 2020. Before we flip over to a larger version of the same chart, keep in mind this is what increasing fear looks like. This is what increasing fear looks like. Here's the indecisive but still holding the major breakout look at the end of October of this year. If we fast forward to year end, we're not getting the increasing fear look. This is increasing confidence. This is a little bit extended from this base here, but there's really nothing particularly alarming on this chart as of noon on December 31st. This is the Triple Q's relative to TLT or long-term treasury bonds. Similar concepts here. This time we're looking at SPY, the S&P 500 relative to TLT or long-term treasury bonds. This is the version of the chart that we covered in the October 30th video, 11:42 a.m. on October 30th. This is before the election. Basically said this is somewhat of a concerning look here. But recent price action looked a lot better than this lower high that we saw in Q1 relative to this high and this lower low here that we saw in Q1. The ratio had held here, and was in the same general area on October 30th. And instead of making a discernible lower high, it had recently made a higher high relative to this high. So before we flip over to the larger version of the same chart, this is what increasing economic fear looks like, and this is what increasing economic confidence looks like. The S&P 500 peaked on February 19th of this year. This was the look of the chart on February 19th. Here's the basic look before the U.S. election, and here's the same look around lunchtime on New Year's Eve. See a little bit of a hesitation in here for the month of December. Consolidation. We are a little bit extended from this base, but once again, we don't really have a look like this over here, a discernible lower high. And the last thing this ratio did was make a new high for the rally in early December. There's no important lows that have been made thus far. Once again, nothing particularly alarming at this point. The chart of TLT in isolation that we covered before the U.S. election. On October 29th, it closed below all of the moving averages. This looks discernibly different from this here. If we switch over to the larger version of the same chart in the present day, does it look more like this increasing Fear look in Q1, or does it look more like the look here prior to the U.S. election? Remember, on January 22nd, price was above all of the moving averages. At 12:24 p.m. on New Year's Eve, December 31st, 2020, we're below all of the moving averages. Here, we're well above an upward sloping 200-day in orange. Now we're below a flattish 200-day in orange. Once again, somewhat of a consolidation. We should be paying closer attention type look, but nothing alarming yet. This is TLT bonds relative to physical gold, GLD, that we covered on October 30th. This is our increasing deflationary fears look here. Here's the look prior to the U.S. election. It looks quite a bit different. If we fast forward to 12:34 p.m. Eastern Time on New Year's Eve, hard to say the move in the month of December here in the blue box looks similar to this increasing deflationary fear look here. Also noteworthy, for several months, this is really somewhat of an indecisive type look here. Not a lot of information on this chart as it sits now, but it definitely doesn't have an increasing fear look to it. Credit markets, JNK relative to IEF, or intermediate term treasury bonds. Here's the S&P 500 peaking here on February 19th of this year, making a higher high. Credit markets making a discernible lower high. Before the U.S. election on October 30th, we said there's a little concern on this chart, but nothing major. The last thing that had happened on this chart was a new high for the rally relative to the prior high that was made in June. If we fast forward to the present day or New Year's Eve intraday, do we have an increasing fear look like this with discernible lower lows? Or do we have somewhat of a confident or not all that concerned look from the credit markets? Flipping over to the larger version of the same chart, here's the look prior to the U.S. election. This is what we want to avoid, an increasing fear look. We'd prefer to see something like this, which is an increasing confidence look. Unlike Q1 of this year, progress in the credit markets, very, very similar to the look of the S&P 500 in recent weeks. This and this, quite a bit different from this clear divergence that we had prior to this peak in Q1 of 2020. The ratio is shown here. This is the S&P 500 on the bottom of the screen. Prior to the U.S. election, we said there were things to be concerned about, but there were also reasons to try to be patient. NYSE advanced decline line, dated October 29th, covered on October 30th. Breath held here, the S&P 500 held. Held here, the S&P 500 held. We were in the same basic area prior to the U.S. election. Thus, if we flip over to the larger version of the chart, in the present day, this is the look at the end of October here. Are we treading water, staying about the same? Has market breadth improved, or has it deteriorated? The answer is it's improved considerably, and it started to improve considerably from this area down here that we covered in October. We said it's concerning, but let's try to be patient. This is the look of the same chart intraday on New Year's Eve, 12:43 p.m. Eastern Time. It's making a new high for the rally off of the March low. This doesn't really guarantee us anything about what's going to happen next week or over the next 3 months. But there's just nothing alarming here that's telling us to get ready for something really, really bad. That could happen, and it could happen as soon as Monday morning, but it hasn't happened yet. In summary, we all know charts cannot predict the future. They simply help us assess the probability of good things happening relative to the probability of bad things happening. Some of the charts that we're looking at are a bit extended from their recent bases, but nothing particularly alarming, but it does tell us we may see some type of short-term pullback. Not a prediction, simply one of many scenarios. We don't have any major cracks on any of these charts. Since this video is being recorded intraday on New Year's Eve, we don't even have year-end data in hand yet. We will cover all of that next week. And as we head into next week, it's good to keep in mind volatility, pullbacks, and corrections are a normal part of all trends, even the strongest of strong bullish trends. Haven't seen anything yet to alter the favorable long-term outlook. Everybody wants predictions. Many of these charts are useful during coincident moves. When bad things start to happen in the stock market, how sharp is this decline here in the credit markets? How much fear is there in the credit markets? This is a coincident move here, but still very useful information. And the only way that we can catch and process a coincident move in the proper manner is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.